Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And in this Q&A episode, we've got heaps of really interesting listener questions. So buckle in. Hopefully there's something in there for you that can help you in terms of making better quality decisions or giving you some insights into some potentially matters that you hadn't considered. Now, my first question is from Peter, and he actually is referring to a case study episode from the 23rd of July 2024. And Peter writes, I'd be interested to know what vehicles the client used as he progressed. That is company, trust, super, personal names, and so on and so forth. Okay, so with respect to that particular case study episode, the geared property was in the highest income earner's name. That was around 2.6 million of his wealth. The shares were in the lower income earner's name. That's about 1.8 million. And then obviously super was relatively even split between both spouses. I guess, I should have probably talked about sort of ownership structures and the strategy around that. But typically as a general approach, I prefer to have geared property in personal names. So if we're borrowing to invest in property, I typically won't put that in a self-managed super fund or a company, sometimes a company, but rarely, and probably almost certainly not a trust, partly because the negative gearing loss is trapped inside that trust. You can carry it forward, but time value of money, you lose a lot of value. And also trusts attract higher rates of land tax in most states as well. So we'll have geared property in personal names, normally more of the property in the highest income earner's name, although there is some benefit in having the lower income earner on title as tenants in common, perhaps up to 20% or something like that. That'll just help minimize capital gains tax as much as possible in the future. Typically, if we're going to invest in shares, we'll either do that in the lowest income earner's name or a family trust, particularly if we've got other beneficiaries to distribute to, or potentially a company, but we might have it in the family trust and then have a corporate beneficiary. But we can get a bit more fancy with shares. And then super typically obviously ungeared. We don't necessarily have any gearing inside super. We can, but we don't necessarily do. And so typically that's why I like property outside geared in personal name. If we're going to have shares, let's have them inside super. And then that's where we can sort of build some diversification. So I just wanted to expand upon that, Peter. Great question in regards to ownership structures. The big thing here is what we're trying to do is minimize tax. Okay, the next question is from Justin. Justin has got a question about Adelaide, and most of us would probably realize Adelaide property prices have been steaming ahead over the last couple of years. Anyway, Justin writes, as I believe South Australia doesn't really have a large economy, it's always been paid over the edge with respect to its GST payout. So he's referring to the federal government splitting up GST revenue. It relies on government handouts. The average wage is one of the lowest in the nation. And in the past, it's always struggled to keep residents from moving to other states, but the house prices keep going up. Is Adelaide market looking down the barrel of a price correction? Your insights would be greatly appreciated. So thanks for the question, Justin. It's a really good one. And I'd refer you to the second chart that I've actually posted in a blog on the 8th of May 2024. So you can obviously jump onto our website to find that chart. But essentially the chart illustrates that growth in all capital cities tends to move in two distinct cycles, a flat cycle and a growth cycle. They tend to follow each other. And to enjoy average growth, you need to have as many flat cycles as you do growth cycles. And that's why you kind of need to hold property, unless you can get the timing perfectly right, you kind of need to hold property for many decades to enjoy the benefits of compounding capital growth. In any case, that chart illustrates that in Adelaide, the median house price of Adelaide between 2011 and 2018, albeit a relatively short 7-year period, was 1.6%. Inflation over that exact same period was 1.9%. So in real terms, property did nothing. In fact, in real terms, it moved slightly backwards. Since 2019, the growth has been 9.2% per annum. But if you average the growth out since 2011, it's about 4.9% from the start of 2011 through to the end of March this year. And inflation over that period was 2.6%. So in real terms, we've had 2.3% growth over the last 13 years, 2.3 plus inflation in Adelaide. So I guess putting that in context, and you always have to put these sort of data and information in context, because what the media loves to do is focus on, what's happened over the last couple of months. I mean, it's newsworthy to talk about, Adelaide's been going gangbusters in terms of price, and watch out, we're looking down the barrel of a price correction. Or so, write that article, you're going to get a lot of clicks, right? So it tends to be short-term commentary. It needs to be newsworthy. It needs to be current to end up in the paper. The reality is, though, that shouldn't influence you as a long-term investor. What you want to do is look at long-term trends. Now, what I did previously is had a look at the median house price in each capital city for each quarter, and then extrapolated it out using the average growth rate to today, and looked at that data back into the early 80s, right? And then took the average. And what I was trying to do with that sort of analysis is consider whether, having regard to prices over the long period of time and realizing that returns always revert to their long-term mean or long-term average, which capital cities overvalued versus undervalued. And so you can see that I discussed that in a blog on the 10th of April this year. So again, you can go back to the website and have a look at that one. And I concluded that Adelaide could be slightly undervalued still, even after the last few years of growth. And so you might see the Adelaide market continue to increase in price over the next 1 to 2 years. But I don't think, looking at that long-term data, I don't think it's overvalued. And particularly if you make reference last 13 years of growth being 2.3% plus inflation, that to me doesn't feel like it's an overcooked market. Now, it's unlikely that prices will fall. I mean, if we have a recession or something like that, I'm not predicting a recession, but if we do have something significant like that, certainly property prices can fall. But what happens when markets get overcooked? They can come back a little bit, but typically they just move sideways for many years. So again, you don't get much growth. I guess kind of like what happened in Adelaide between 2011 and 2018. There was no real growth relative to inflation. So I wouldn't be too worried. I mean, they can get really overvalued, and we've seen that in some kind of regional and coastal areas. After COVID, prices have come back 10, sometimes 20% in some of those regions. So you can get pockets like that, but if we're just talking kind of an average of a capital city, that tends to not happen. Adelaide as a investment location, I think the population is just too small. Let me flip that around a little bit. Why would I want to go and invest in Adelaide when it has a population of not even 1.5 million people, where compared to, say, Melbourne, for example, that has over 5 million people? In Melbourne, you're going to have a lot more diversified industry, employers, demand, much tighter imbalance between supply and demand as well, particularly in the good quality blue chip locations. So there's a few reasons I wouldn't recommend investing in Adelaide. I mean, particularly now, given, it's just been through a growth cycle, and, maybe, as I said, that growth cycle could continue another 1 to 2 years, but we're towards the end of it. And so the risk is that you go and invest in Adelaide today, and then the next 7 years, you're not going to get any growth. Relative to other states, your investment's going to underperform. So great question, Justin. And it's a great example for me to take to sort of say, okay, great, let's look at recent growth, but let's take the lens out a bit and look at long-term trends. Okay, my next question is from Jake, kind of an interesting one. He says, "Hi, Stuart, thanks for all the fantastic content." Thanks, Jake. Jake goes on, "I was wondering what your thoughts might be in regard to using trust structures when building out a property portfolio, specifically for the pure purposes of conserving borrowing capacity. I understand this strategy incurs disadvantages, including higher accounting costs and loss of immediate negative gearing benefits. Would this, however, be negligible downside when considering the ability to build out a much larger portfolio and future tax saving benefits when dispersing income to beneficiaries such as children?" So thanks for the question, Jake. Look, if I have interpreted the question correctly, it's presupposing that investing in a family trust is going to somehow magically extend your borrowing capacity. Now, that'd only be true if it was non-recourse, what they call non-recourse lending. Non-recourse lending means that you don't provide personal guarantees as the director of the trustee company or the trustee of the trust, but most vanilla lenders these days will want you to provide personal guarantees, and as such, it impacts your personal borrowing capacity. That is, when you go go to a lender and apply for a new loan. They'll do an asset search. They'll see you've got this trust. They'll do a credit search. They'll see that you've got these loans, and they'll include the commitment when calculating your borrowing capacity. I have heard limited circumstances where you get fringe lenders that might ignore loans inside an entity. I haven't heard a lot of it, but just you hear things or come across things every now and again. But really, we've got to consider, if you had an unlimited borrowing capacity, does that mean you should go and borrow unlimited funds? Because there's two questions we need to ask ourselves. How much can we borrow? How much should we borrow? Just because someone's going to turn around and say, Stuart, I'll lend you $20 million doesn't mean I'm going to go and borrow $20 million. You still got to give consideration to interest rate exposure, risk, cash flow, all those sorts of considerations. So I put to you that actually investing through a trust isn't going to change your borrowing capacity, and the negative gearing benefits, which Jake alluded to, being sort of trapped inside the trust, you carry forward those losses, you get to use them in the future. You can't underestimate the huge benefit of enjoying a tax break today versus enjoying it in 20 years' time. When you model that out from a financial perspective, it's actually a huge benefit. The thing Jake didn't allude to, which I alluded to earlier on in this episode, is land tax. If you invest in a discretionary trust, you're going to attract higher land tax. And then Jake mentioned, well, you might get some future tax benefits when distributing income in the future. Well, firstly, you need to make sure you've got individuals to distribute to. And if you're not planning to do that for 20 years, who knows whether those individuals are going to be around and it's going to be worthwhile to distribute to them. Secondly, there's not necessarily going to be a lot of taxable income. And look, if you go and sell the property, you can have a capital gain. Hopefully that's a huge capital gain and you might get some benefit there. But I wouldn't be putting huge weight on future tax discretion with respect to property elements unless your plan actually involves divesting of a particular asset at a particular time, but you just want to be careful about putting too much weight on some of those things. So thanks for your question, Jake. I hope that answers it. Okay, the next question is from Rowan, and I know I always say this, but this one is, I find it particularly interesting. Rowan gives me some fantastic feedback about the podcast, so thanks very much for that. Anyway, Rowan writes, recently I've established a self-managed super fund and I'm looking to invest in properties through a buyer's agent, focusing on Perth or Adelaide due to growth prospects and lower land tax for trusts. He's currently based in Sydney with an existing investment property in Brisbane. I'm considering long-term prospects of income-yielding geographies like Perth, Adelaide, or even regional southeast Queensland, compared to locations such as Sydney and Melbourne, which offer lower yields but higher capital growth. Whilst I understand your preference for quality investments, recent trends have shown affordable locations, those under 600,000, performing well. Could you share any research or insights on whether better income yielding areas can match or outperform higher growth cities over the long term? So that's why I think it's a really good question. It's true, you can look at a lot of kind of, let's call them regional locations, so not blue chip, inner city, capital city locations. And the last, 5 to 7 years, they've performed really well, which I think is a risk because, if you get dazzled by that relatively short-term performance, it could invite you to make a mistake. And I've thought it's a great question, Rowan. I've been thinking about it quite deeply over the last few months. And my thesis was, that those outer sort of areas are historically overvalued relative to blue chip inner city property. That's my thesis, which I've mentioned before in a couple of videos on YouTube. I've talked about it, which put differently, I think blue chip property is cheap relative to property that might be sort of new build area that doesn't have very much scarcity. You might have to pay $1 million for a house that's 35, 40 Ks from the CBD in Melbourne, or even Sydney. And I think whereas you can buy something, albeit on small land size, buy a house, 2 or 3 bedrooms for maybe $2 million. So it's only twice as much, to get something that might be like 6 Ks from the CBD that's in walking distance of everywhere. And to me, you look at those two locations, two types of assets, my hypothesis is that those blue chip properties are undervalued. The problem is, I reckon I can find some data to support my thesis, and which might think, okay, that's good, Stuart, go and do that. But my problem is I'm really skeptical about the data. I'm skeptical about suburb-based data just because it's not always statistically reliable. See, the problem is in the share market, there's lots of great data. We're trading every single day. all participants, you could argue, are economically motivated. So whereas more than 50% of buyers in the property market are buying a home, they might not really be that. They'll be thinking about the finance side of it, but their motivation isn't necessarily primarily to build wealth. In fact, I would say more than 50%, that's not their motivation. And so you get some different behaviors in that market. It's not traded as often. Properties not very comparable. From a data perspective, you might get one particular part of the street that's very busy near a main road and the other part of the street is very quiet, and you're comparing those two different price points, they're going to behave differently. Whereas with the share market, you can isolate factors. You can compare companies that are operating in the same sector, and compare sort of gearing ratios, profitability, these sorts of things to try and highlight or segment, different factors might influence different behaviors and different investment outcomes. You can't really do that in the property market. The other thing too is that property prices or property price data will include capital improvements and maintenance over time. And that's again also hard to isolate. So if you're going into an area that's gentrified, typically when an area gentrifies, people go and buy and then they improve the property, the actual improvements, the dwelling on that property, and that all gets mixed up in the capital growth rate. So people go, oh, look what this suburb has done over the last 20 years when it's, going through some gentrification. And it's true, the underlying land value's probably changed and probably changed a lot, but there's also been a lot of capital improvement as well. So I reckon I can go and cherry pick some suburbs, if you like, and some time periods and try and demonstrate that, hey, this inner city blue chip property is undervalued, but I'm not really. I think my conclusion is, and I said I've been thinking about this for a while, my conclusion is that data's not very reliable, because equally you could probably get someone to mount the alternate case, to say that actually these outer city locations perform better, from a yield and capital growth perspective in terms of the aggregate return. Now, when you're talking about high yield locations, you might want to have a look at a blog I wrote on the 29th, published on the 29th of November 2023, so last year. The title of that blog is What Does the Rental Yield Tell You About a Property? And I talked about, yield is sometimes, might be suggesting that the area is undervalued, which is then great from an investment perspective, or it might be a sign that that area doesn't provide as much capital growth. There could be lots of different reasons. You might want to check that blog out, Rowan. But here's the crux of my answer. When we're looking at this data and we're comparing regional southeast Queensland to, say, Melbourne and Sydney, blue chip locations in Melbourne or Sydney, this is what I put to you. My goal as an investor is obviously to build wealth. The easiest way to build wealth is to enjoy compounding capital growth. And so what I plan to do is I plan to go and buy a property that's worth $1 million today. I should hopefully get 7.2% compounding capital growth over very long periods of time. That would be my reasonable assumption. And that would mean that my $1 million property in 10 years is worth $2 million. In 20 years, it's worth $4 million. And in 30 years, it's worth $8 million. So over the next 30 years, I'm going to accumulate $7 million of equity. Now, my question to you then is, which location do you think has the fundamentals to push prices along at that level over the next 3 decades? Well, I think the answer is obvious, right? But let me give you a stat that's something to really think about. 50% of Australia's population, over 13 million people, live in Melbourne and Sydney and Brisbane. Melbourne and Sydney and Brisbane, in terms of land mass, make up less than 1% of the total land mass in Australia. So 50% of the population is trying to live in only 1% of the land mass. Now, it depends on how you break this up. I think I've checked it out on Google in terms of to calculate it, and I'll leave room for the possibility that maybe it's not perfect. Maybe it's actually, as I understand, less than 1%, but I've just been conservative. My point is that what we're trying to do is invest in property and achieve the highest average capital growth return over the next 30 years. There will be locations outside of Melbourne and Sydney in terms of blue chip suburbs that will perform well, that might even do better. There will be those locations. Picking those locations, however, is like finding a needle in a haystack, in my mind. Chances are you could try and pick a location, hang in there for 30 years and you'll be wrong. We can't get that time back again. So my view is then let's take the lowest risk. Let's invest in the location where 50% of the population want to live, but it's only 1% of the land mass, so that everyone wants to get into this location. And chances are it's going to give me the highest probability of actually achieving my goal, which is 7.2% growth, which means I invest in $1 million today. In 30 years, I've accumulated $7 million over that 30-year period. So that's my viewpoint. That's my thesis in terms of approaching this decision. The challenge is I'm making a 20 or 30-year decision where most investors are tending to think much more short-term than this, and that's where people end up making mistakes. It's a long-term investment. I've spoken about before that, super can fund the first part of your retirement. What you're doing now is investing today so that you're going to be able to boost your net worth when you're in your 70s or even 80s. So you can afford to take that long-term approach, hopefully. Anyway, great question, Rowan. As you can see, I've thought about it a little bit, and hopefully those insight, add a bit of flavour to the argument. Okay, my next question is from Barry. It's kind of similar to Rowan's question, but then has a little bit of a tilt. So, I won't repeat myself, hopefully. Anyway, Barry asks, my question relates to your rules on investment grade properties. When I look at certain regional towns on RP data, I see growth similar to capital cities over the past 10 years. Is it fair to say that regional towns will each, those that have strong growth and good future growth prospects, have their own investment grade properties, meeting your rules, and therefore might make similar percentage returns, albeit the number might be smaller than capital city? And just for context, Barry goes on to say, the reason I ask is that my wife and I have owned and renovated many properties over the last 25 years, landing us in a very strong equity position in our current primary place of residence. We are now selling that to downsize, as the kids are adults, to fund projects. I'm 52 and my wife's 48. We realise we need to make some significant uplift in the next 5 years to fund a good retirement. So we're looking at doing 2 renovate, subdivide and build projects and then hold them for another 10 years and sell them. When I run the scenarios in cities, no matter how I run the numbers, I run out of borrowing capacity and would probably need to sell the front renovated house to free up capacity to do 2 without waiting a few years, which gives rise to some opportunity cost. So, as I said, Barry's question is a little bit related to the most recent one that I answered for Rowan, in that it's sort of comparing regional growth rates with capital city growth rates over the last 10 years. Of course, the last 10 years has been skewed by the COVID boom. That had an impact on growth rates. So, I'd be looking over much longer periods of time. And as I said in my answer to Rowan, it's really about, my strategy is really about, buying something today, holding it for 30 years and achieving the highest compounding capital growth over that time period. Now, you can't necessarily take that approach to your strategy, Barry, because your strategy is shorter term than that. Your goal isn't necessary to hang on to the property for 30 years. You want to actually manufacture some equity to improve your financial position. And so that's a good warning, I think, for most listeners or all listeners of this podcast. When I'm talking about the strategies that I utilize or strategies that I've recommended to clients, they're purpose specific, right? If you're looking to do something different, then a different approach might be more appropriate. So, Barry, in your situation, you're not going to want to spend too much on land value. I mean, you want land value, but the developments typically don't economically stack up, say, in blue chip locations, just because the cost of land is so expensive. And so those development opportunities, small scale development opportunities, typically are more economical in secondary suburbs. So 10 to 20 Ks out from the CBD where land is a little bit cheaper. That's when you can then demolish the existing dwelling and maybe build 2 or 3 townhouses, for example, and hopefully make, north of 20% in terms of profit margins from undertaking that small scale development. So I would imagine in your situation that actually buying either in a capital city but in an outer sort of suburb or in a regional location, although be very careful about the regional location. As I said, it's had that COVID spurt, so you just want to be careful with that. But what I would do in your situation is it's a who question, not a what question. Barry, I would go and speak to as many people that I could find that are undertaking the sort of developments and strategy that you want to undertake. And, maybe you can find a mortgage broker, for instance, that specializes in those small scale developments. I'm sure you could. And they will have clients that you could talk to, for example, because it's really lack of experience is the thing that's going to trip you up. I get you've done many renovations, so you might not need a lot of help with that. But really, with respect to where is the best location, that's what I'd try and research. And look, there's a final part to Barry's question. He says, I guess if I can add another question, being very focused on projects and uplift for the next 5 years, are we better off to rent while we're both still working and use all our funds from the primary place of residence on projects rather than buying a small house outright. This might increase our borrowing capacity. Look, it's hard to say because I don't really know your numbers, Barry, but if the goal is to buy today, improve, and then sell in 10 years' time, I would be thinking about minimizing entry and exit costs. And obviously, one of the big exit costs is going to be capital gains tax and land tax over the holding period. So, I mean, you need to speak to your tax agent, but I would be thinking about maybe you could buy the project, occupy it, claim it as your principal place of residence. You might then move out once it's demolished, but then at least you can still claim that as a principal place of residence and minimize your capital gains tax. Now, you might not be able to minimize it or eliminate it completely depending on what you're building, but you might at least be able to minimize it. So that's the way I'd be thinking about it, not really from a borrowing capacity perspective, but really from how can I use the main residence CGT exemption to help me magnify the post-tax profits from these projects. Okay, as you know, I like to keep these episodes around about half an hour, so I'm kind of out of time. I've got lots of other great questions, so I hope you keep listening. Just a quick reminder, it's been really popular. I've got a 97-point checklist, a financial health checklist that, addresses things like how to choose investment grade property, planning for retirement, property tax deductions, all those sorts of things. The link is in the show notes. If you're interested in that, maybe jump in there now and download it, and hopefully it's going to add a bit of value to you. Until tomorrow, bye for now.